Hey everyone, welcome to today's lesson of contract for difference, also CFD for short, and what it is. So basically, understanding contracts for difference, you'll see CFD or contracts for difference a lot online and in every brokerage account, or almost every brokerage account, as they're basically innovative financial products that allow the benefits of stock market trading without requiring you to own the actual assets. So with CFDs, you speculate on the rise or fall of prices across a variety of markets, including stocks, commodities, and currencies, using a fraction of the capital traditionally required. So basically, in short, CFDs democratize access to financial markets, allowing for more regular people like ourselves to invest into, let's say, the US stock market or the Singaporean stock market. To explore later on that CFDs basically allow you to invest indirectly in a market or in a stock or indirectly into a currency pair or whatever without having to go through the legals of actually owning that stock outright. So what is a CFD? CFDs are basically like options, futures, forwards, etc. They're all part of a group of financial instruments called derivatives, which are contracts that trigger payouts depending on the price evolution of an underlying asset. Thus, the name derivative, as its payouts derive from an underlying asset. So, in the case of a CFD, it's an agreement between you, the investor, and a broker to exchange the difference in the price of an underlying asset from when the contract is opened to when the contract is closed. So essentially, you bet on whether the price of the asset will go up or down without ever owning the asset itself. So CFDs are about the change in price of an underlying asset and not the actual physical ownership of assets. So in the case that you enter, as mentioned before, you enter a contract with a broker to make this bet about the price movement of an asset. So to open a CFD position, you choose an asset that you believe will change in value. So this could be a stock, commodity. So let's assume it's the stock of Tesla, and your profit or loss is determined by the difference in price from when you open and close your position. So when we open, in the case of a long position, so it's basically when you buy, and when you close position, when you sell. The reverse is the case for a short position where you pre-sell high and then you buy back low. That's when you open and close. So if you predict the price movement correctly, you profit. If not, you incur a loss. So instead of the broker giving you money, you owe the broker money if you predict it wrongly. So in this example here, a CFD long position is made directly with a broker, meaning that A, if the price goes up, the broker owes you money, and if the price goes down, you owe the broker money. The opposite is true for a short position. So there, if the price goes down, the broker owes you money, and if the price goes up, you owe the broker money because it's going the opposite way that you want it to. What are CFDs used for? You can open a CFD on practically anything that your broker allows. So the stocks, currencies, commodities, ETFs, index funds, etc. And CFDs are used to basically allow retail investors, so this is us, so non-professional investors, to easily invest or trade without the costs or legal hassle of investing directly into a market. So you can bet and invest indirectly using a CFD. CFDs also allow you to do fractional investing. So let's say the price of an Apple stock would be $2,000, and you only have $100. Normally, you would not be able to then buy that Apple stock because you don't have enough to buy a whole share. So via a CFD, you can get around that and just bet on the general price movement. So you can still invest with $100. As the CFD position is made directly with a broker instead of directly with the market or buying the asset outright, where either you owe them money or they owe you money by the end of the position, depending on if the price movement goes your way or not. So, how do CFDs use leverage? You'll hear leverage a lot when it comes to CFDs. So, what makes CFDs a very popular but also risky financial product is leverage. So, if you decide to use leverage on a CFD position, and just as a FY, leverage means using debt or using not your own money, it allows you to gain a large exposure to a financial market while only tying up a relatively small amount of your capital. So, as I just mentioned before, what is leverage? It's basically using borrowed money from the broker to magnify the size of your position. So, here on the right, we have a construct of a CFD. This is your money, and then this is the borrowed money, and therefore you magnify your whole position in the market. And we'll explain what position is in a bit. So let's just do an example. So how CFDs use leverage. So for example, with a 10 to 1 leverage, your initial investment of, let's say we start with $1,000, controls $10,000 in the market. This basically amplifies your profits and losses by 10 times. So your $1,000 that is put up is known as a security margin, or margin for short. So this money that you put in here, this $1,000, this is known as the margin. Now, depending on the margin level that you choose, you're determining the amount of leverage that you're working with. So let's imagine you want to invest $1,000 in a CFD on stock X. Let's assume you invest to buy at a margin of 1%, which is a very low margin. In this case, you have a leverage ratio of 1 to 100. So the $1,000 you invested in are multiplied by the leverage ratio to come to a position size of $100,000. This means that with an investment of $1,000 of your own money, you've reached a position as if you simply bought $100,000 worth of stock X with your own money. You can also do this with a lower level of leverage, or in this case, a higher percentage margin. So, for example, with a margin of 5% instead of 1%, you would have a leverage ratio of 1 to 20, which means with a $1,000 investment, you reach a position size of $20,000. This means it's as if you bought $20,000 worth of stock X with your own money. So to better understand this, let's go through an example calculation. So let's assume you want to trade with your CFD broker at a margin of 3%. This means I could invest $300 into stock X, and these $300 then reach a position size worth of as if I invested $10,000 directly into stock X. So with $300, I reach a $10,000 position size where $300 represents the 3% of the whole position. This is what a 3% margin would mean. While the rest of the money, $9,700, is put up by the broker. So we borrow money from the broker to reach this size. So yeah, since you're operating a margin of 3%, this means you're dealing with a leverage ratio of 33.33, as described here. Now let's assume the worth of your portfolio increases by 3%. So this is the graph of a particular stock X, and it increases by 3%. Now what happens? With this 3% increase, your entire position increases by 3%. So now, this goes up by a total of $300. And since I only put down $300, this $300 is now increased to $600 because the borrowed amount of money, which is the debt, that doesn't change, but the overall position size has changed. So all that gain goes to our personal money, or our personal equity/margin. So now you have a 100% gain on the original $300 that you invested, since it now goes up to $600. You've doubled your money. Congratulations. This demonstrates the positive effect of using leverage. So for a 3% gain in the portfolio size or in the price movement, you've got a 100% gain on your money. So with leverage, we're basically able to put less of our own money down to have just as large a profit and a much larger return on investment. So what does that mean? With only $300 put down, we got a $300 gain back. This would have happened in the same scenario if we actually invested $10,000 of our own money without any leverage, just $10,000 of our own capital, and got a 3% increase. We would have also gotten $300. So it's pretty much almost the same in terms of absolute dollar profit. But the difference is we only use a tiny amount of our own capital. We only use $300. So the percentage gain is 100% instead of 3%. So we have a much larger return. And return here is the percentage gain. So how does this look if the stock went down 3% down instead? This is a typo. This should be went, not when. So if it goes down 3% instead, what happens? Now your stock portfolio would fall by 3% from 10,000 to 9,700. So the leverage CFD on the right would reflect this drop as if you invested $10,000 yourself. So the position size has now decreased to 9,700. The borrowed money obviously doesn't change, but the money that we put in, that's what gets hit first, and we've now lost the entirety of our margin. The $300 is completely wiped out, and we've made a 100% loss on your money. So this is pretty much where the risk of CFDs come in. If the portfolio lost more than 3%, so it goes down to 8% and only down to 9,200, then not only is your margin lost, so your $300 lost, but you also now owe money to the broker and would have a debt. Now, this entire effect, this would all lead to something called a margin call. Now, in a margin call, The broker would ask that you replenish your margin since the previous margin of $300 has been lost, or your margin is going very, very low and you're on your way to losing it. So this could already happen even if the stock tanks, if the stock decreases by 2% only, and you still have $100 left of your original 300. If it's on its way down to being wiped out, or if it's already wiped out, you would get a margin call. So the entire risk in this scenario is that you're not only losing your margin, but that you could also build up increasing debt. So if this were to continue going down, you first lost your money, but then you start losing the broker's money. And the broker obviously doesn't want to lose its own money, or else you'll be in debt. So what the brokers can do is during this margin call, when they ask you to deposit more funds to build up your margin of safety, to build up your margin so that you're fine, they want to avoid this scenario. So they may force a trader to sell assets elsewhere in your portfolio, regardless of the market price, to meet the margin call if the trader doesn't deposit funds in time. So this is pretty much the worst case scenario. This is what a lot of people in the world on the internet don't really realize, is if you trade with leverage and you take a bit of a dip, there's not going to be any waiting around to wait for the price of the stock that you're betting on to go up again. Because if you go down a certain amount and your margin, it gets wiped out or it gets low and you're forced into a margin call, they can force you to pretty much sell off your investments. You personally are taking a huge loss, but they do it so that they are covered, so that you don't enter into this debt scenario, so that their assets are protected. And you end up losing all of your money. You're no longer invested in anything, so it can no longer go up. And that's pretty much the worst case scenario. So overall, we can see that CFDs are a great way, great tool to participate in the markets without having to directly invest. So yeah, this is why CFDs will be available in the majority of brokerage apps, and it's the main thing that you'll be trading with. Since, as mentioned before, the CFDs has many benefits where you enter a contract with a broker instead of investing directly into the market. And it avoids the legalities of investing or owning a stock outright. So you can basically participate in the markets without having to invest directly. And it can magnify your profits and losses using leverage. So because of this leverage, it's also very risky, and you can burn your money very quickly, as seen before in the margin call scenario. So this is why in most brokerage apps that use CFDs, we want to recommend to not use leverage, as we don't want to use any debt. So we set the leverage to 1x, i.e. no leverage. So using no leverage with a CFD is basically, financially speaking, the same as directly purchasing the asset, but just without the legal ownership. So let's look in the app to show how we can set this. So let's just go into the app. So let's go here. And let's say I want to, okay, let's go into the Discover section. Let's go into the stocks. And let's say I want to open a trade on Apple. So here I would click on trade. I want to buy maybe $1,000. And here it's already set to 1x because I've already set this previously. But when you first open your account, you may see that the leverage is set to 5 times or 10 times or 20 times. We want to always set this to 1 times, which means, let's say this $1,000 multiplied by the leverage ratio, 1 times 1 is still $1,000, which means we're only using our own money. We're not using any borrowed money. We're not using any debt. We're not using any leverage. So 1x means using no debt. Here it also explains a little bit from the broker side. Leverage multiplies your initial investment, using less capital to gain more exposure, as we explained before. And as a note, this can amplify profit and loss, putting your capital at significant risk. So we don't want this. We want only 1 times. We don't want to stop loss. We also don't want to take profit, since we're in this for the long term. And if we set a certain take profit, I mean, we could set a take profit, but I just want to be in this particular stock or whatever it is, index fund. I want to be in it for the long term. I don't want to constantly keep checking back into my account. So that's why I don't set a take profit, because what happens if you then reach the take profit? Okay, you close your position, you make the profit, but then there is cash sitting in your investment account that is not invested in anything. It's just sitting there like cash. And if I'm not checking this brokerage account every month or whatever, and I want a few months to go by, because we want this in the end to not take up much of our time, we don't want to have a wasted opportunity of money that's just sitting as uninvested cash. We always want to keep it invested, which is why we don't want take profit to be set. You can, of course, if you want to keep more of an active control, But since we're just investing mainly into index funds and ETFs and we're invested in the long term, we don't want to take profit set. So we set it to market order. Just as an FYI, in case this wasn't explained before, market order is when you buy it right now at whatever current price it is. And a limit order is when you set a particular price that you want to definitely buy at, and it will only buy or sell at the particular price. So generally speaking, I like to keep my life simple and just buy at the market order at whatever the price is. I set it to buy 1x leverage, so that's perfect. And done. So order sent and order filled. So you can always see in our portfolio, okay, I'm long on Apple, great. I didn't use leverage, and that's it. So you might be asking, why is leverage even offered at all? And why is it the standard setting on many apps? So it's mainly targeted at traders. So on a day-to-day basis, most assets like stocks or commodities or currency pairs don't really change all that much in price, usually at most a few percentage points a day. If there's a large movement, it could be even more than that, but usually it's only a few percentage points, if anything. And without leverage, let's say the maximum return you can make on $1,000 of trading capital is limited to those few percentage points. So in this case, you're making like $10, $20. Whereas with leverage, you can magnify your profits by 5 times, 20 times, 100 times, or even more through this leverage. So whether your trading capital is $1,000 or $10,000, even if you have so little of your own money, leverage allows you to pretty much magnify the profits you can take while risking a small amount of your own capital. So you can make then a lot of money trading on a trade with even such small percentage point movements. But as mentioned before, trading for most is by far incredibly not successful. Most people lose money on this. So we're not interested in trading or magnifying profits or losses, or we don't want this additional risk. It does not fit with our strategy. This is why we do not use leverage, as we also don't want extra fees that's associated with borrowed money, or a margin call that, in the worst case scenario, forces our position closed and forces us to take a loss and pretty much wipes out all of our margin, all of our own personal money. So we want to stay smart, simple, and automatic. We want to not use leverage, but we do want you to understand what a CFD is, what leverage is, so that you can make the right settings when you're in any brokerage app. And yeah, that's basically it. But yeah, hopefully I see you in the next video. Bye bye now.